Well, hello then everyone, and welcome to today's week ahead video. We're going to get started with the calendar. I'll flip across the calendar and we'll see where assets lined up over the course of last week and potentially what to expect in the coming week. We had a few raft of central banks out last week. We had the Fed, we had the ECB, we had the Bank of Japan. Now the Fed last week came out and said to us that they were going to hike interest rates, or they were looking at hiking interest rates another 50 basis points into year end. Now that was the first pause. They did not hike interest rates last week, which was the first time since March of last year, when they've continuously hiked interest rates at the most aggressive tightening cycle we have seen in many years. They come into this week then, and what we're looking ahead towards this week is Jerome Powell's testimony over a couple of days across Wednesday and Thursday to see where he feels, or what he feels, after the market's reaction to the news last week, to get more of his thoughts on where he sees monetary policy going over the course of the rest of the year, which is what markets are looking towards. Now, markets are still betting against the Fed hiking by a further 50 basis points. I still say there's a 75, or there's actually a 72% chance now of markets or of the Fed hiking at their July meeting by 25 basis points and then being done with it through to year end, and then potentially looking at rate cuts at the back end of this year and into 2024. So it is a saying of markets of don't fight the Fed, but what markets are doing now is definitely fighting the Fed. So it's something we need to keep an eye on over the coming months. Do markets continue to fight the Fed, or do they start to believe them that interest rates are going slightly higher? But if inflation does continue to remain sticky, which Jerome Powell said it was, if that continues to prove a problem, we may even see rate hikes further than the 50 basis points that markets do, or that the central bank do feel will come into effect by year end, right? So that's something we need to keep an eye on this week. But I think the Bank of England does take a centre stage over the course of this week. We see 25 basis points worth of hikes is the consensus, but markets are anticipating potentially a terminal rate up towards 6%. So we want to see some communication from Andrew Bailey on Thursday as to whether that is actually something that may happen. Inflation is still higher than kind of any other country within the G8 space. You can see the previous 8.7% consensus is for only a drop to 8.5. Now the bank do still insist that inflation is going to fall off a cliff in the second half of this year, but that's what other central banks have suggested, and that has not proved true so far. So are the Bank of England an outlier, and the ones that have managed to predict it correctly, or are they wrong just like everybody else? Again, is another question that we need to think of over the rest of this year. But we have to expect a hawkish BOE, I think, over the course of this week, which I think is an interesting one when it comes to the Swiss National Bank, which we also have out on Thursday. You can see Thursday the SNB, the Swiss National Bank, where we are 8:30 a.m. You can see a 25 basis points worth of hikes. So previous 1.5, consensus 1.75, further 25 basis point of hikes. But with inflation still at 8.7% in the UK and with it at 2.2% in Switzerland, sterling Swiss upside may potentially be on the cards. With a more hawkish Bank of England, there is need for the Bank of England to be more hawkish than there is for the Swiss National Bank. Does that suggest some potential upside over the course of this week for sterling Swiss? Again, remains to be seen, but for me that would definitely be worth keeping an eye on, or is an asset that I will personally be keeping an eye on for some potential upside over the course of this week, right? In terms of high impact data, that's really all we've got over the course of this week. We do have Fed Chair Powell, obviously see the testimony that we were speaking about a little bit earlier on. We got inflation out the UK and the Bank of England as well on Wednesday and Thursday. Apart from that, not a great deal. You do have the RBA, the minutes, unexpectedly hiked interest rates a couple of weeks ago for the second consecutive meeting. These minutes may potentially give us further indication as to whether these interest rate hikes are going to continue, but they did suggest that there is potential for them to continue, but we need to keep an eye on the incoming economic data before the next release of before the next interest rate decision. Apart from that, not a great deal. You do some consumer confidence figures out of the UK, do some retail sales figures out of the UK, but the Bank of England likely to drive price action across sterling over the course of this week. Now, we've had a little bit of a negative start to this week off the back of no update on Chinese stimulus, potential for some Chinese stimulus in order to prop up their economy. Now, Goldman Sachs did come out recently and downgrade Chinese growth forecasts, and the Chinese central bank have suggested a need for some increased stimulus measures in order to support the economy, as the economy, since it opened back up post-COVID, has not provided the gains that some may have hoped. So Chinese central bank potentially providing some stimulus that should be positive for risk, positive for stocks, and the fact that we've not got that has been a slight bit of a negative to start the week, but that's not really too surprising. You can see solid upside across the S&P, across the Dow Jones, and across the Nasdaq over the course of the last couple of weeks. So a bit of a pullback is not unexpected. The fact that we have got a pullback probably is a slightly healthy pullback, but we do not have any trading or any active trading today any active trading today across the US, or kind of active market participants. Futures markets are trading, but in terms of the bank holiday situation, in terms of the celebration of Juneteenth, is not likely to prove not likely to provide too much market participants across US trading later on this afternoon. So liquidity likely to be low, volumes are likely to be low. Does that give us much movement in the afternoon? I would suggest possibly not. But if that downside does continue and we do see some negative sentiment stepping back in, with markets potentially accepting the fact that interest rates are going to be higher, which is then negative for stocks, with if China do not increase stimulus measures and stocks do turn to the downside, I think the one to play is the Russell, right? If markets do imply that, okay, maybe we are heading towards a recession is coming, the Russells are generally a better gauge across US indexes about or to do with a recession. So if we do get a recession, I think Russell might be the way to play it. You see a bit of a head and shoulders across here with a pretty good neckline across the Russells, and if the S&P, the Dow Jones, and the Nasdaq do sustain some downside, I think the Russell then gets dragged with it, which I think is probably a better bet for some downside, especially when the technical setup is there, as well as the correlations with the other asset classes. The Nikkei, definitely one to keep an eye on. Obviously, it's been a bit of a parabolic move, is stalling a bit up the highs here since Tuesday of last week, but with Bank of Japan leaving policy settings unchanged, continuing to look for some upside across the Nikkei, not the worst idea in the world. Still US dollar downside, you can see the trend is still intact across Euro, Dollar, Aussie, and Cable. Right, Cable with the Bank of England in focus this week, probably a decent bet for some upside if US dollar weakness does kick back into gear. You've seen Kiwi dollar, the uptrend across the Kiwi dollar is not the same as the other currency pairs. You can see obviously a bit of negative sentiment across there, but once you kind of wind in, since certainly over the course of June so far, the uptrend across the Kiwi has not been the same as the rest of the currency pairs. So now if a bit of US dollar strength does step back in off markets accepting interest rates are going to be higher and starting to believe the Fed, well then Kiwi dollar may be a potential way to play it. But dollar yen always in focus when we get this type of a conversation, because that is quite heavily linked to US bond yields. Bring us on to US bond yields is a bit of analysis to be done on this, right? If markets do start to believe that interest rates are going to be higher and they are going to come in over the top in terms of what they are pricing in, this then should push higher. So some bonds downside, yields upside, and the longer this move sustains, if this continues to the top side, that should drive dollar yen with it, with that increasing rate differential between the Japanese 10-year yield and the US 10-year yield. That then will cause further upside in dollar yen, and if this gets above the 3.85% number resistance level that got mapped up here, which technically, or certainly from a technical perspective, doesn't look like the worst idea in the world. You can see go from here to here to here to here, are printing higher lows up to a flat resistance level, an ascending triangle, which is a known bullish price pattern. If this does continue higher, breaks above here, dollar yen upside or increased downside in the yen likely to continue. across here, you can have a look here. You can look at Aussie yen, you can look at CAD yen, you can look at the way that they are moving, especially if oil continues to push higher lows and higher highs across here. There's some downside off the back of reduced Chinese demand, but if you do get some stimulus measures out of China, and then you do get increased demand, with OPEC cutting oil supply or cutting output, has triggered a bit of upside across oil. And if you do get some upside across oil, US yields pushing higher, dollar yen pushing higher, Canadian dollar off the back of Canada continuing to hike interest rates after being on a pause. Got a hawkish central bank supported by higher oil prices. You got dollar yen pushing higher. If yields break through the highs, that is a recipe for CAD yen higher. So I think CAD yen, sterling Swiss, not bad ideas to look at over the course of this week. And if yields keep higher, keep pushing higher, that should put some pressure on stocks. If these do push to the downside, the Russell one to keep an eye on. So a few assets in focus this week. I would suggest probably sterling Swiss, potentially some CAD yen, the Russell, and certainly that 10-year yield to give you some direction across other asset classes. Definitely not a bad idea of assets, or a bad range of assets to keep your eye on. Main focus of attention, Bank of England this week, which we will be sure to update on further a little bit later on in the week.